Hi, I'm Patu from FreeFinCal, and today let's talk about two risks that are difficult for mutual fund investors to escape from. One is fund manager risk or fund manager exit risk, like for example, SN Lahiri's exit from L&T Mutual Fund, and I'd written about it yesterday. And also the other one that some debt mutual fund investors are worried about is the Vodafone idea bonds, and these have been put on negative credit watch, and there is a fear and a real possibility that they could default, or at least the grading ratings could go further down, and the NAV will drop down. So with respect to debt funds, at least credit risk is something that you cannot escape from. Whatever the debt fund, whether it's overnight fund, liquid fund, whatever it is, it's very difficult. The reason for that is because of the way in which debt funds have been created. Because even there are no, see, for example, if there is a fund that holds only cash and in a current account and sovereign bonds, whether it's a one day bond or one day gilt fund or 40-year gilt fund, it doesn't matter, only gilts, sovereign bonds and current account, then the risk of credit, credit defaults or credit problems is practically zero. I mean, just say effectively zero. But other than that, if once there is any other party involved, any other lender which is non-government involved, there will always be some credit risk, and it's going to be there in overnight funds, it's going to be there in liquid funds, it's going to be there in every kind of fund. PSUs also can suffer, and it's very difficult to find funds that hold only gilt, and that's the only problem. And I mean, don't say there's parak liquid. It doesn't say so in its. I want a fund that says in its scheme document, we will invest, we will have only cash, and then we will have gilts. That kind of a fund does not exist on paper. That's the big problem, and it was available before the SEBI categorization, and now that's bad. There was a few short-term gilt funds, and they're now not available anymore. And the biggest problem is credit problems can occur in arbitrage funds, credit problems can occur in hybrid funds, aggressive hybrid, multi-asset, whatever, any kind of hybrid funds, and so on. So there is really no escape. The only way you can mitigate this risk is by choosing funds which have got a huge AUM, especially bond funds or arbitrage funds. They got a huge AUM, so that the exposure to individual stocks are like just a few percent. I mean, if it's less than 5% or 5% or so, you should be able to take a 5% drop in the NAV. I mean, it's a risk. That's a risk you take when you buy a debt fund. I mean, you can't say I want only returns and not risk. So there is no escape from debt funds. Some investors feel that we will exit now. I will exit the funds holding Vodafone and I'll move to another debt funds. There is really no escape. Something will happen there. Some other there will be a default there. You can't keep running. You can't keep switching and switching and switching. Effectively, the tax outgo from such switches will reduce your returns. I mean, you might think it's better off being in a fixed deposit than stay in a debt fund, and that's a very, very valid reasoning. I would say for short-term goals, stay away from debt funds. If you're scared about credit risk, stick to FDs and RDs. And for really long-term goals, you can use, if you're worried about credit risk, there are gilt funds you can use. I have talked about it, written about it. You can manage your portfolio, by effective rebalancing, then gilt funds are an option. Just a second, this seems to be, so okay, this seems a little slow in reacting, but that's fine. So all right, so that's one thing. And the other thing with respect to fund managers, see, fund managers are merely employees of the AMC, and they're always going to leave. Whatever position they are in, they're always going to leave, and this is a problem. So I think if you are going to be an active fund investor, I would suggest don't look at who your fund manager is. Focus only on the performance of the scheme. Or if you're going to worry about who the fund manager is, when they have come in, when they have exited, and so on, then the only option for you is index to become an index investor. In the case of Lahiri, I myself had done an analysis and showed, as Rajkumar had pointed out in Asana days, well, I myself had pointed out that Larry had made a difference to I think L&T emerging businesses, if I'm not wrong. But I had only looked at only one fund at that time. But if you look at all the other funds he has managed, only the mid cap and the small cap funds have done well. The large mid cap and the tax saving funds that he is also managing have not really are not really category toppers. So one can argue it's just the market movement and not the fund manager's entry into the fund that has changed the fortunes of those L&T funds. So it's always the fund manager's role, positive or negative, entry wise, exit wise, everything is always debatable. If it worries you, there are only two ways to mitigate that worry. One, stop worrying, stop looking at who is managing your funds. It's always possible. I have no idea who is managing my funds. Except some very prominent names, unfortunately, I don't, which I'm accidentally I know. Other than that, I don't know. Only look at performance or shift to index investing. So these are two of the several other risks. The more prominent one is the price up and down risk, but these are two risks which are not known. For example, star ratings cannot compute the effect of the impact of credit rating before it happens. So that's a problem, and also fund manager risk. So uh, that's what I wanted to say in this video. Please check out that article, and I'll catch you again later. Bye.